Welcome to the Radix Review. Tune in each week as co-hosts Jay Denton and Chris Nebenzahl cover the key trends in the apartment industry, macroeconomy, and much more. Hello, everyone, and welcome back. Today is July 10th. Thanks for tuning in to the Radix Review. Let's start things off. Jay, how was your 4th of July?
It was terrific. I'm still exhausted from it. Family trip to Las Vegas, of all places. Hot as can be in the desert, but we had the best time. How about yours?
It was good. It was good. We escaped the Denver heat, went up to the mountains for a little bit, and had a good time. It was a good 4th of July. There was a parade. There was some fireworks. So a good couple days for sure. All right, Jay. Well, what's happening in the market this week?
Well, let's talk about your market of the month. We've wrapped up the first half of the year. We've wrapped up June. So curious to hear from you on your market of the month. Which one really stood out for June? And then the latest jobs report just came out. And we'll talk about what the headlines said, but then what are some of the underlying, maybe I think you phrased it as cracks in the foundation that we might be seeing in the labor market. So Chris, why don't we start off with what's happening in multifamily?
Absolutely. So as we've talked in the past, we're past the leasing season. Typically that's April, May, June. July still tends to be a decent month, but we definitely start to see the plateauing of metrics across multifamily. We've seen traffic and leasing really slow down in the past couple of weeks. Occupancy even ticked down ever so slightly in the past couple of weeks. I know you and I made a big deal about occupancy reaching 94%. Well, unfortunately, we're back under 94% at 93.98%. So occupancy is starting to at least stabilize, if not slow a little bit. You mentioned the market of the month. We are back with a market of the month for the second month in a row. This month, it's Huntsville, Alabama. So we talked a lot about Wilmington, North Carolina last week. We're sticking in the Southeast. Huntsville has had a really, really good month of June. Occupancy rose 60 basis points. Even traffic and leasing. Again, I mentioned this is typically the time when traffic and leasing starts to slow down. Certainly stabilize, if not slow. But Huntsville gained 0.7 of a tour per property last week. Touring is above the national average at 8.6 tours per property. Gained almost a half lease signed per week in Huntsville, all the way up to 3.8 leases signed per week. That leads the nation. So Huntsville, Alabama is certainly seeing a ton of demand. We had talked about Huntsville as one of those smaller markets that was flying under the radar, but still getting hit hard, just like Austin and Nashville. Lots of new supply. Certainly in smaller markets, the impact of one unit, one property is even bigger than it is in places like Dallas or Atlanta, even more so than Nashville and Austin. But Huntsville had been getting hit pretty hard on the supply side. Rents were down, occupancy was down. But again, Huntsville is one of those markets that we've seen recover and recover quite quickly. I expect that market will do very, very well now that the supply boom is kind of behind them. Again, you see almost 4 leases signed per property per week in Huntsville, leading the nation. Really, really good demand on the rental side and continued job growth. Certainly Huntsville has the aerospace presence, a lot of STEM jobs, a lot of science jobs. So Huntsville is our market of the month. Really, really good June. And I expect that to continue. Now, again, zooming out a little bit to the first half of the year, we mentioned on the last podcast, some of those markets on the West Coast really doing well. Again, that has surprised me. Those markets have really outperformed through the first half of the year. For those who didn't tune in last week, markets like Riverside, markets like Seattle and Portland, these were markets that have been struggling in the past couple of years. Really, really starting to bounce back, really starting to show some strong fundamental performance. So, we used to look at a couple of pockets. We said the Northeast was doing good. Pockets of the Midwest were doing good. The more I look at it from a demand perspective, from an overall multifamily performance perspective, you really have to look at the entire nation except for the Sun Belt, which is, kind of interesting, especially for those who've been in this industry, even going back before COVID. Coming out of the GFC, it was the coastal markets, but through kind of 2015, 2016, 2017, we were talking Sun Belt. Certainly in the recovery from COVID, it was Sun Belt, Sun Belt, Sun Belt, Sun Belt. And now it's really kind of that upside down smile states, the arc states, if we want to coin that term. California, the West Coast doing well, the Midwest doing well, the Northeast, the Mid-Atlantic doing well. Really, the pockets now are the pockets of weakness. It's the Southeast, it's Florida, it's Texas. Perhaps it's still a little bit in Phoenix and Las Vegas, but again, Las Vegas and Phoenix are on the road to recovery. So, perhaps a flipped script from what we've talked about in recent months and recent years. The weakness is starting to be acute, and it's really heavily concentrated in those Sunbelt markets. So overall, steadiness in multifamily. Huntsville is our market of the month. Really, really good growth. First half of the year, we saw growth on the West Coast, continued strength in places like Detroit, Minneapolis, Chicago, and the Midwest. And those markets in the Northeast like Boston, DC, still performing well. So Jay, tell me a little bit about what you're seeing in the jobs numbers. I know we just got First Friday last week.
Yeah, I was going to mention one thing on something you going through the markets, just because I feel like I really need to. I was looking at the latest list, and I think Detroit has the second highest rent growth, year-over-year rent growth in the country right now. And I don't know about you, I can't think of a time in my career where that's ever been the case. So I just want to give a shout out to Detroit for seeing some rankings that I've never seen.
Absolutely. And Detroit is, it's been a much maligned market going all the way back to the GFC, certainly one of the hardest hit markets in 08. But yeah, Detroit has emerged. And that was one of the markets we covered a lot on in our mid-year review. So absolutely, shout out to Detroit.
All right. Well, circling back, so answering your question in terms of the job market, the thing that's obviously fueling a lot of the demand in these different metros, particularly the ones that are outperforming. The headline number from the BLS report, much like many of the recent reports, the headline number looked pretty solid. 206,000 jobs added in the month of June. If we just kept that pace up as a country on and on, we would, that's pretty solid. The challenge is when you start to dig below those numbers, and we've mentioned this multiple times in our recent calls, that the good news is the headline, the bad news is almost everything below the headline. In particular, I would start with the revisions to the last 2 months report. So for listeners who aren't as familiar with the BLS reporting process, when each new month's information is released, they go back and revise the past 2 months. So sometimes the more jobs would have been created than what was previously reported. But typically what we've seen for quite a period now is the reports that were just issued a month or two ago were actually too optimistic for what was happening at that point in time, and the job growth gets revised down. So it's like I said, we just got a 206,000 job report, but is that going to hold? It hasn't been holding in many of the recent months. So the last 2 months were actually revised down by 111,000 jobs. That is very significant. We talked about in a recent podcast, that old ratio of for every 5 jobs added, 1 apartment unit was absorbed. That ratio might not exactly still be the same today, but if you take that would have meant that 22,000 fewer apartments would have been absorbed or had the potential to be absorbed given the amount of jobs being created. And the absorption doesn't always happen specifically when the new job gets created. It's a little bit of a lag effect. So maybe that's the type of reason that we're seeing occupancy start to come down from that peak that you mentioned, what looks like a peak for the year of just around 94%. The revision was one of the, I think, weaker parts of that job report. Unemployment ticked up once again. It's at 4.1%. Historically, very strong. But when you see it continually start to edge up, that starts to show a little bit more weakness. Industry. I know we've talked about, the industry job creation a lot in our client facing presentations that we do here on the podcast and other written commentary. The theme continued. 75% of the jobs created in June were either in healthcare, social assistance, or government. And the private sector is not really adding jobs to the economy at this point, especially if you take construction out of it. And I'm sure some of those construction jobs are fueled by some of government spending in some form. Not all of them, but I'm sure it helps to some degree, but construction is basically the only private sector that's really adding jobs. Professional and business, as an example, that overall sector lost 17,000 jobs, mainly because temporary services were really down. But we're not seeing the strength in the private sector that we need to see. So it makes me then wonder, I mentioned on the last, I think it was on the last podcast, or maybe the one before that, we were talking about interest rate impacts. And I know that you've been looking and seeing some different opinions, and there's some different ones out there in terms of interest rate. Will the Fed look at this and maybe think a little bit differently than it did just a month ago? So, what are some of the things based on this jobs report that you're seeing that people think that might impact the Fed's decision?
Yeah, it's a good question. And this, we don't know what the Fed is going to do quite yet in the July meeting, in the September meeting. But what I've been seeing recently in the past couple of days is that this jobs report might be kind of the straw that broke the camel's back for the Fed. You mentioned unemployment rate steadily increasing. A lot of economists were saying one cut, maybe September, maybe November, who knows when it'll be. And then yet in the wake of this recent jobs report, which as you mentioned was strong at the headline level, Citigroup just published a report that said they expect 200 basis points of rate cuts between now and July of 2025. That even 5 days ago, 6 days ago, to me would have been unheard of. The Fed's dot plot said one cut this year, 4 cuts next year. The city's now calling for 8 cuts in the next 8 meetings, or I should say 200 basis points worth of cuts in the next 8 meetings. That would shock me. I would put that at kind of the far boundary, the far end of what might happen. I've also seen economists now calling for a July rate cut. There will be a Fed meeting this month. I personally don't think that they'll cut this month, but what the Fed can do this month is be very clear that they're expecting a rate cut in September. Perhaps they indicate that they might go to 2 rate cuts this year. The Fed has always wanted to be very transparent. They don't want to rankle markets. They don't want to shake things up. And so in the July meeting, could they cut? They could. Again, that would surprise me, but I expect them to be very transparent with saying, look, we've seen the inflation data come down. We've seen the jobs data start to weaken. We are now ready to start easing monetary policy. And that's what I think they'll do in July. In all likelihood, cut in September, maybe take November off because they don't want to appear political. But I think we could see 2 cuts this year. It wouldn't surprise me if September and December are back on the table. Again, cities calling for 2%, 200 basis points by next July. Again, that would surprise me. I think we would need to see significant economic deterioration before that happens, and I just don't see it yet. I may be naive in that, but I don't see a tremendously weak economy in the next year. But who knows? A lot of economists are starting to see significant activity on the interest rate side.
Yeah, I agree with everything that you said there. I think if there's that big of a cut from now to next year, we have a lot of other challenges happening. And I mentioned before in a previous podcast that, will there be enough information between June and July to really change the decision? And I think you're spot on with what you believed. It's more about the communication and expectation setting. And that if this continues, I would imagine that we would likely, for what I know, for what I read, that September could start to look more likely for that first rate cut this year. And then also, keep in mind that, we've been seeing 25 basis point movements. There's potential for, a 50 basis point in December or something like that. So it'll be interesting to see how it plays out. I will say that, while I don't like the underlying kind of themes below the headlines, it is nice when you're analyzing the market and something just doesn't feel right. Like when I observe people in the job market, and I've talked to people in the job market, and I go to conferences with a bunch of HR people or recruiters, and they don't seem to think that the job market's as hot as what the BLS reports have been so far this year. And when the reports start to match the sentiment, it's not like I'm trying to have bias towards it, but it hasn't felt as strong as what the reports have been. And now I think it's starting to come in line, and we're understanding it a little bit more.
Yeah, absolutely. And just for some real-time color here, Jay. When looking at the 10-year Treasury, the 10-year Treasury was at 445 on the 3rd of July. Now the market was closed on the 4th. The jobs report came out on the 5th, and that 10-year is trading down about 15 to 17 basis points already. So again, looking at some of these Treasury rates, implying that we might see lower interest rates, implying that we might see some cuts, implying that there's more weakness, as you're mentioning, in the employment market. I'll be watching kind of the 2-year and the 10-year Treasury rates as proxies for, okay, what is the market expecting? How is the market digesting some of these reports? And we will see one more inflation report coming up in the next week or so. So that will be very indicative of kind of where the economy's at, perhaps give us some visibility into what the Fed's thinking. So definitely a couple of data points to watch out for in the next few weeks. All right, well, Jay, I know we are just kind of getting back from vacation and a slower week last week, not just in the Radix world, but in the economy and in the market. Anything else you wanted to cover on the economy, on the multifamily market, on the Radix front before we wrap up for today?
No, just looking forward to second half of the year. I think we have some very exciting product things coming out that you and I will be involved with, whether it's our forecast or some other things that we have in the pipeline. So looking forward to getting the second half started.
This has been the Radix Review, and thanks again for joining us.